Margaret thought she had done everything right. A retired school teacher from Dayton, Ohio, she spent 32 years shaping young minds, paid into Medicare with every single paycheck, and counted the days until her 65th birthday, the way a child counts the days until summer. When she finally turned 65 in March, she was still working part-time as a tutor, still covered by her husband's employer plan, and the Social Security office told her she could delay Medicare without any issue. 2 years later, when her husband retired and the employer coverage ended, Margaret finally enrolled in Part B. And that is when the letter came. A permanent late enrollment penalty of 20% added to her Part B premium every month for the rest of her life. The math works out to just under $2,000 extra every single year, compounding across her remaining decades, and no appeals board, no supervisor, no senator's office can remove it. Margaret did nothing wrong in her mind. She followed advice, but the advice was wrong, and the penalty is forever. If you are approaching 65, or you're helping a parent who is, you need to understand exactly how this penalty works before you make an assumption that cannot be reversed. This video is for educational purposes only, and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. With that said, let us talk plainly about something most retirees are never warned about in time. The Medicare Part B late enrollment penalty is one of the cruelest quiet rules in the American retirement system. It does not punish you for a single mistake at a single moment. It punishes you for every month you delayed, and then it keeps punishing you forever. The formula is 10% added to your standard Part B premium for every 12-month period. You were eligible, but not enrolled. Delay 1 year, pay 10% more forever. Delay 2 years, pay 20% more forever. Delay 5 years, pay 50% more forever. The standard Part B premium for most retirees in 2026 sits at around $185 a month, which means a 20% penalty adds roughly $37 per month, or about $444 a year. That sounds small, but penalties stack on top of future premium increases, so as the base premium rises each year with inflation, your penalty amount rises with it. Over a 25-year retirement, a 20% penalty will cost you well over $12,000 in real money. And a 50% penalty, that number climbs past $30,000. For a penalty, you could have avoided with a single phone call. Here is the trap most retirees fall into, and it is the exact trap that caught Margaret. There is a special enrollment period that allows you to delay Medicare Part B without penalty if you have qualifying employer coverage through your own current job or your spouse's current job. The word current is doing heavy lifting in that sentence. The moment the employment ends, or the moment the group coverage ends, the clock starts ticking. You have 8 months to enroll in Part B, not 12, not until the next open enrollment period. 8 months from the end of employment or the end of group coverage, whichever comes first. Miss that window and you are stuck waiting until the general enrollment period, which runs from January through March each year, with coverage not starting until the month after you enroll. That gap alone can leave you uninsured for months, and the penalty begins accruing the moment your special enrollment period ends. Robert, a retired electrician from Erie, Pennsylvania, learned this the hard way. He retired at 67 with what he thought was generous retiree health coverage from his union. His HR contact told him it was as good as Medicare. Retiree coverage does not count as current employer coverage under Medicare rules. It never has. Robert delayed Part B for 3 full years, thinking he was protected. When he finally enrolled, the Social Security Administration assessed a 30% lifetime penalty. At today's rates, that costs Robert more than $660 a year, and it will continue climbing as premiums climb. Over his remaining life expectancy, that single piece of bad advice from a well-meaning HR rep will cost him somewhere between $16,000 and $20,000. Now let us talk about COBRA, because this is where even more people stumble. COBRA is the federal program that lets you continue your employer coverage for up to 18 months after employment ends. It feels like employer coverage. It looks like employer coverage. You're still paying into the same plan you always had, but Medicare does not treat COBRA as current employer coverage. The moment you leave your job, your 8-month special enrollment window starts, even if you are paying for COBRA. Most retirees assume COBRA protects them from the penalty. It does not. If you're on COBRA for a full 18 months and then try to enroll in Part B, you are already 10 months past your deadline, and the penalty has already begun. This is one of the most common, most painful, most permanent mistakes in all of retirement planning, and almost no one warns you about it in advance. Retiree health plans fall into the same category. Severance health benefits fall into the same category. VA benefits do not exempt you from the Part B penalty, although they do provide health care. Health insurance purchased through the federal marketplace does not exempt you from the penalty. Only true current employer group coverage, tied to either your own active employment or your spouse's active employment at a company with 20 or more employees, qualifies for the special enrollment period. If the company has fewer than 20 employees, Medicare is typically considered primary at 65. regardless, which means you probably need to enroll even if you are still working. Here is what makes this so painful. The penalty does not just apply to Part B. There's a separate, equally permanent penalty for Part D prescription drug coverage. The Part D penalty is calculated at 1% of the national base beneficiary premium. For every month you are eligible but not enrolled without creditable coverage. Creditable coverage means a prescription drug plan that is at least as good as standard Medicare Part D. Your employer plan probably qualifies. Your spouse's employer plan probably qualifies. But once that coverage ends, you have 63 days to enroll in a Part D plan before the penalty begins accruing. 63 days. Not a year, not 8 months. 63 days. The average Part D penalty for someone who delayed 3 years comes out to about $14 a month, which sounds trivial until you realize it also never ends. Over a 20-year retirement, that is roughly $3,400 of avoidable cost, and the numbers get worse as the national base premium rises. Let us talk about the income-based surcharges that pile on top of everything, because this is where many retirees get a second unpleasant surprise. IRMA stands for Income-Related Monthly Adjustment Amount, and it is how Medicare charges higher earners more for Parts B and D. The thresholds for 2026 start at modified adjusted gross income of $106,000 for a single filer, and $212,000 for a married couple filing jointly. Cross that line by even $1, and your Part B premium jumps by roughly $74 a month on top of the standard premium. Cross the next threshold at $133,000 for singles, and the surcharge nearly doubles. IRMA looks back 2 years, which means your 2026 surcharge is based on your 2024 tax return. A one-time Roth conversion, a large capital gain from selling a rental property, or an unusually high required minimum distribution can trigger IRMA for a full calendar year, and then drop back the following year. If you are already paying a Part B penalty, IRMA adds on top of it. Penalty plus surcharge compounds the damage. Carol, a retired nurse from Tampa, Florida, ran into this combination. She delayed Part B for 2 years because she kept working as a private duty nurse and thought her small LLC qualified as employer coverage. It did not because she did not have 20 or more employees. She enrolled late, picked up a 20% penalty, and then the following year she sold her late mother's house, and the capital gain pushed her into the second IRMA tier. Her total Part B premium that year ran over $310 a month, more than double the standard premium. The penalty portion alone cost her about $450, and it will continue costing her that adjusted amount every year forever, even after IRMA drops off. So how do you protect yourself? The first rule is simple. 3 months before you turn 65, call your local Social Security office or go online to ssa.gov and confirm in writing whether you need to enroll in Part A, Part B, or both. Even if you plan to delay Part B because of current employer coverage, enroll in Part A. Part A is typically free if you or your spouse paid Medicare taxes for at least 40 quarters, and there is no penalty for delaying Part A as long as you're not contributing to a health savings account. That last point is important. If you're still contributing to an HSA and you enroll in Part A, you must stop HSA contributions 6 months before your Medicare effective date, because Medicare Part A actually backdates up to 6 months when you enroll late. Coordinate carefully. Second rule. If you are delaying Part B because of current employer coverage, keep documentation. You will need Form CMS L564, the Request for Employment Information Form, signed by your employer to prove you had qualifying coverage. This form is how Social Security confirms your special enrollment period. Without it, you may be assessed a penalty even if you technically qualified for the exception. Get the form signed while you're still employed. Do not wait until after you retire and try to track down an old HR contact who may no longer work there. Third rule. The moment your employment ends, or the moment your group coverage ends, mark 8 months on your calendar and treat that deadline like a tax deadline. The Social Security Administration will not remind you. Your old employer will not remind you. Medicare will not send you a warning letter. The penalty simply begins accruing, and you will not discover it until you finally enroll and see the higher premium on your first statement. Enroll using Form CMS 40B, the application for enrollment in Medicare Part B. You can submit it online, by mail, or in person. Fourth rule. If you take COBRA after leaving employment, do not assume it protects your enrollment window. It does not. Enroll in Part B at the same time you start COBRA and let Medicare coordinate as primary. Most retirees find that dropping COBRA entirely and moving fully to Medicare is cheaper and more protective, because COBRA premiums without the employer subsidy are typically significantly more expensive than Medicare plus a Medigap supplement. Fifth rule, and this one catches people with higher incomes. Request a new IRMEA determination using Form SSA 44 if you had a qualifying life-changing event, including marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income-producing property, loss of pension income, or an employer settlement payment. If your income has dropped significantly since the tax year Medicare is using, you may be able to eliminate or reduce your RMEA surcharge for the current year. Social Security is not going to tell you about this. You have to request it. Now there is one pathway most retirees never hear about, and it can occasionally reduce a penalty that was assessed by mistake. If you can demonstrate that a federal employee gave you incorrect information, whether by phone, in person, or in writing, and that you relied on that information to your detriment, you may be eligible for equitable relief. The standard is high. You need documentation, you need specific dates, you need the name of the person if possible. But equitable relief has removed Part B penalties in documented cases, and it is worth pursuing if you believe you are genuinely misinformed by an official source. You can initiate a request through the Social Security Administration or through your state's State Health Insurance Assistance Program, often abbreviated as SHIP, which provides free Medicare counseling in every state. Let us do the math one more time, because numbers land harder than warnings. Assume you are 65 today. You delay Part B by 2 years because you assumed COBRA counted, and you enroll at 67 with a 20% penalty. Your standard Part B premium is around $185 a month. Your penalty adds $37 a month, or $444 a year. If you live to 90, that is 23 years of penalty. At a conservative 3% annual increase in the base premium, your total penalty paid over the remainder of your life comes out to roughly $15,000. That is $15,000 of real money after tax for a mistake that cost nothing to avoid if you had known the rule. And if you delayed for 5 years instead of 2, that same calculation climbs past $38,000. $38,000 for a single phone call you did not make. Most retirees do not learn these rules until it is too late. They learn them from a penalty letter, from a friend who got caught, from a forum post on a Tuesday night. The quiet cruelty of the Medicare system is that it expects you to know the rules without telling you the rules. Your employer's HR department is not trained on Medicare. Your financial advisor may not specialize in healthcare transitions. Your insurance broker sells plans, not enrollment strategy. The only entities with a clear duty to tell you are the Social Security Administration and Medicare itself, and both of them rely on you to show up, ask the right questions, and submit the right forms at the right time. If you are approaching 65, take 3 concrete actions this month. First, request a benefits verification letter from Social Security that confirms your enrollment status and eligibility dates. Second, contact your employer's HR department and get a written statement of whether your current coverage qualifies for the Medicare Special Enrollment Period, along with a signed CMS L564 form to keep in your records. Third, identify your state's SHIP counselor and schedule a free consultation. SHIP counselors are trained specifically on Medicare transitions. They do not sell anything, and they can walk you through the exact enrollment sequence for your situation. And if you have already been assessed a penalty, do not assume it is final without exploring equitable relief. Pull together every document you have about the advice you received, every email, every note, every timestamp. Contact your SHIP counselor. Request a formal review. Most penalties are upheld, some are not. It costs nothing to ask, and the potential upside is the removal of a lifetime surcharge. The rules around Medicare enrollment are not designed to punish you, but they are designed to hold you accountable for your own timing, and they do not forgive ignorance. The retirees who protect themselves are the ones who learn the rules before the deadlines, not after. You are listening to this now, which means you have time, which means you still have control. One more thing worth emphasizing before we close. Medicare rules change in small ways every single year, sometimes in ways that affect enrollment windows, penalty calculations, or income thresholds. What was true last year may not be true next year, and what your neighbor experienced 5 years ago may not apply to your situation today. The only reliable way to stay on top of these rules is to check official sources at least once a year, ideally in October when the following year's premiums and thresholds are announced. The Medicare.gov website, the Social Security Administration, and your state's SHIP office are the 3 sources that will give you the most accurate current information. Do not rely on forum posts, old articles, or secondhand advice from friends who enrolled in different calendar years. If this breakdown helped you understand something your last advisor never mentioned, go ahead and subscribe, because we are publishing a new retirement protection video every week covering the rules that cost ordinary retirees the most money. Hit the bell so you do not miss the next one on IRMA appeals, where we walk through the exact SSA 44 form line by line and show you how to reduce or eliminate your income-based surcharge. And if you know someone who is approaching 65, send them this video today. One shared link, one honest conversation might save them $15,000 over the next 2 decades. That is the kind of favor nobody ever forgets. We will see you in the next one.